Um, Hi everyone who joined. Welcome to Challenge Accepted session. Today we're going to talk with Avi Eyal, who's the co-founder and managing partner at Entrée Capital. Hi, Avi.
Hi. Thank you for having me.
Good to have you here. Just a quick note before we start. I want to talk a bit about Startup for Startup for any of you who don't know us. Startup for Startup is Monday.com's initiative for sharing knowledge, experience, and actionable insights with the startup ecosystem. A part of what we do is this type of events, but we also have a podcast under the same name. We have quarterly events, founders column where we interview founders. Wait,
yeah, she's China. How's that?
That was interesting. And we have a lot of more initiatives. You can find everything on our website and also on our Facebook community. You can join right now as we speak and join our discussions. So today we're going to talk about entrepreneur-investor relationship. And it's a big topic. So I'll just run by a few points that we're going to discuss. So first, we're going to discuss how does the communication change before the investment and after the investment? Why is it so important to maintain good relationship with the investor? And why can it be complicated sometimes? Avi will share with us best practices for maintaining good communication between founders and investors. And then we'll move to your questions. You send us a lot of questions. So I'll start with a few questions that you send us, and you can also send us throughout the session in the chat, and we'll try to cover as many as we can. And then we'll open the discussion, and you can also ask Avi directly if you want to. So I'll stop the share screen right now, and I'll move to talking to you, Avi. So first of all, really good to have you here.
Thank you for taking the time to join us this evening or this morning if you're in the States. Just a bit of background. I run a venture capital firm called Entrée Capital, which was started in Europe. And when I came to Israel, we started growing our funds in Israel. Today, we manage around $650 million across 5 funds. And one of our earliest investments was Monday.com. It was known as the Pulse in those days. We were the first check, the first investor. We continued investing when no one else wanted to invest. And we've continued to invest along the way. Today, we're the second largest shareholder of Monday.com. And I have the extreme privilege and honor to sit on the board of Monday and luckily still interact with the business on a daily and weekly basis. So as Daria said, we want to discuss today a bit about our view on what it looks like as investors and founders have a relationship as they grow that relationship from dancing before an investment, dancing together, and then once having invested, how does that change, or how does that stay the same? So everyone knows the good stories. Everyone knows how the investor helps, or the founder does it all himself, and businesses grow and they become great, and et cetera, et cetera. But what people don't generally talk about is the bad stories and the red flags and things like that. And I think that to start off with, one needs to consider the relationship when an investor meets a founder. It doesn't make sense for a founder to oversell or to lie or deceive an investor coming into any financing round, because inevitably these things catch up with you, and they will just be a bad taste as an investment progresses. a lot of investors will always approach an investment as trying to be your friend and trying to be on your side and tell you how much they want to build a business with you, and et cetera, et cetera. And one of the things that a founder should consider is one, to do due diligence on the investor, call references of companies the investor has invested in and companies that have failed when an investor has been involved. I like to specifically aim all the founders that I approach. I like to aim them at one or two companies that have failed. Because for me, it's very important for these founders to realize that when things go wrong, that I was there with them through thick and thin.
So maybe Avi, you can give us an example of how does the relationship look like when things go wrong and you can't be there by their side.
Sure. So one is when one makes an investment, everyone's starting off positively. There's cash in the bank, and everyone's running, spending, growing, and building. But that doesn't necessarily mean that will continue over time. What happens is that 6 months in, a year in, there's more doubt. Cash is going down, typically, in most cases, and inevitably, the startup has to go and raise funds. Now, as that process starts, a couple of things happen. One, the founder wants to know that there is an investor they can lean on. So is the investor going to follow their rights? Are they going to put their front foot forward? Following your rights and saying, I'll be pro rata in the next round is kind of a sitting on the fence move by an investor. Because the investor is generally hoping that if the round is a super round, then he wants this piece. And if it's not a super round, then hopefully the investor who does come in wants a significant amount that the investor can back off. But what you want to do is as an investor, if you've made an investment and you believe in the company, despite the hiccups and despite the challenges where most companies will go through it, you always want to say, I want more than my pro rata. I want to support this business and grow my share in the business. And whether an investor effectively does that or not ultimately is very key for a founder, because it fundamentally changes the message that the founder is going out to raise money. Additionally, what happens is that you can't wait as an investor for a founder to be literally out of cash before you're injecting cash into the business. When you make an investment, when most VCs make an investment, if it's not a hard no, if the business is not completely off track, won't make it, no chance, an investor has reserves. And when we say investor, we're generally talking about funds, and they have some reserves. And what you need to do is you need to get your investor to commit early to supporting you. So whether it's a safe or convertible note or something, you want them to put something to give you a bit of back, to back you up so you can run. Too many times investors disappear when there's a fundraise, and it's very important to try and keep them engaged and keep them aligned with you. Now, in order to do that, you can't kind of come 18 months after a investor invested and give them a call and say, hey, we're doing a round. It starts off from when the investment is made, that once you have an investor's money, you actually have a contract with them. That contract is that as they support you, you will support them. And so it's important to be top of mind, always be seen to be throwing things towards your investor in terms of always tell them about your friends or other people who are raising, kind of show that you're interested in their business as well. It's important to keep them up to date regularly. Ultimately, they hold the purse string, so you can't have what we call in everyone's Jewish here, probably, I suppose, or mostly it's a farubel. You can't have a farubel with your investor and hope to then turn around and raise money for them, or expect them to come and help you, because people have their own nature. And so it's very important to keep investors up to date. Now, it doesn't mean you have to keep them up to date daily or weekly, but typically at the beginning of the first year in the business, you should keep them updated monthly. And from the second year, you can move more to something every second month or every third month, depending on how the business grows. But again, if you want to keep consistency and you see that you're going to need to rely on your investor to continue to back you, you want to be engaging with them. You want to be opposite them, feeding them information, not telling them that you can't share information with them. Just find a right basis for being able to share the right amount of information, not too much, not too little, to keep them interested.
Right. And I think also, Avi, that you want to maintain good relationship with your investors, not only because they might invest in the second round, because you as an investor, you can help the company as it goes, even without thinking about the next round, right? You have a lot of things you can do to help the company.
Correct. So typically you've got to work on a basis that if a founder tells you, a set of information or a set of things that they will do for you, that you can't really expect them to do more than 10 or 15% of what they tell you. And inevitably you have the challenge of trying to get the most you can out of them. And to keep them friendly, to keep them on side is something very critical. So one, don't lie. Two, be truthful in your dealings with them. Three, don't wipe out your investors. Your first investors are actually your most important investors through the lifetime of the business. And so many founders forget that, because the first investors were the believers. They were the early adopters, and they stood by you when times were hard, when you couldn't raise that first round of funding. They paved the way for you to be able to start your business and raise from others. And all too often, when the new investor or the second round, the third round investor comes along, their view is, don't worry, we'll look after you as the founder, and I've got to get my share. And the people who get squeezed in the middle between you, the founder, and the new investors are the existing investors who invested in you. And all too often what you see these days is that the seed and the A investors get squeezed down, where all the new rounds get taken care of themselves. And what we've tried to instill in a lot of our portfolio companies, also because we are very early investors, but we believe that you have to carry them along. And I'll give you two examples of it. There's a deal that we're doing in London now where a company raised a funding round at, let's call it £10 a share. I'll just kind of abstract some of the numbers. They found it hard because of a regulatory environment to get going, but they're starting to get going and they're starting to do well. And during Corona, they had to do a convertible note with a 20% discount, et cetera. And then they've now finally managed to raise their next funding round at a reasonable up round from where they were. So where they were raising before at 10, they're now raising at £30 million. But what's happened is, because of the convertible note and because of the situation that's arisen and the share ownership plan that they have to keep people incentivized, it turns out that the new round is coming in effectively at £9 a share, whereas the first round was £10 a share. Now, I'm participating in the A round, in this new round. So on the one hand, I'm happy. I'm averaging down. I'm getting shares cheaply. But what I did was, kind of, my view was, all of you, the new investors, the existing founders, you're making a fundamental mistake here. That is, these are the people who backed you at the beginning. And as a director on the board of the company, you don't have an obligation to look after your own stake, where the lead investor is only interested in looking after their own stake because they're putting more money into the second round. So you have an obligation to your first investors. And pretty much I stood my ground on it against most of the other new investors and the founders. And what we managed to do was to correct the funding round so that it was a 10% upside to the seed investors. because these people are going to carry on. They're going to talk about you in the market, and they're going to spread the news about the company, the founders, the new investors. And what do you want them to spread? That the founders didn't care about anyone. That's going to come back in the next round. That the A round funders are actually a bunch of pigs because they are willing to dilute the early investors without good reason. Doesn't make sense. We've had another occasion where the same thing has happened now in Israel with a deal that we actually just signed the term sheet today of, where the investor coming in is kind of, we're going to re-up the founders by giving them more shares, and we're going to get a low price into the business and bugger everyone the 3 or 4 rounds that came before us. And effectively what it means is that the round is effectively a 10%, 15% up round on the last round, instead of the company executing, doing well, and it should be 2 times or 3 times the share price. And again, we kind of used our, in this case, we actually used our power as a veto to say to the founders, you're not doing this round.
In this case,
so much, but because it hurt the people who came before us, who invested their time and their money to build the business. And so I come back to the fundamental that it is so very important that you treat people equitably, your investors, and investors treat their founders. It's not, when the times are hard, it's not a time for founders to screw for investors to screw their founders by saying, oh, things are going badly, so actually I want double the shares and I want warrants and I want things like that. It's a time to reflect and say, what do we change? And how do we put the best foot forward to make the business succeed? And what it costs you in the short term as an investor, you will make in spades down the line. So I think when you choose your investors, you need to choose wisely. You need to think about what is the baggage? How do they treat the situations where things are hard, not when things are easy? Because when things are easy, everyone's happy. Everyone's kind of, throwing huge numbers out and good luck. But when times are hard, that's kind of sets the difference between a good investor and an average investor. And so a lot of your due diligence on your investors should be done on that.
So I wanna go back to the beginning, to the point where the founders and the entrepreneurs, the investors first meet, and how do you start building that relationship even before the investment? How do you build the foundations to a good communications down the road as well?
So I suppose that becomes quite a personal thing. I think that a fair amount of investors will try to woo the founder and try to impress on them how big they are and how strong they are and all the resources they have, and et cetera, et cetera. And that kind of helps, and that sometimes helps win a highly contested funding round. The other side of it is investors who sit on the fence and say, yes, we'd like to join the round, but we won't lead the round, and optionality counts for them. And I kind of put them at the bottom of the list when you look at investors, because they'll always be there in case a Sequoia or an Andreessen or an Entrée Capital comes along to back you. But the reality of it is they're only there because they want to follow the big tickets, the big names. My personal approach is kind of different. I learned this from my first mentor maybe 30 odd years ago. And that is kind of be pleasant, be nice, be honest, but just be direct. Just get into the numbers, get to understand the business and the person very quickly. And some people take it to be, he's a difficult guy. He made us work hard. He made us, he really investigated us. We felt like we got a lobotomy coming out of the meeting. But, my view is very different. My view is I don't want to waste your time, and my time is a premium. And so I just want to get to understand the business and what the options are.
Right.
But what happens in that discussion for me, in the most part, 80% of the time, is that I end up challenging the founder and the founder ends up challenging me. And in doing so, the result is that you come up having a much better idea of what the business could be. And therefore, you position yourself in a very different way. And so the deals that we do, many founders, and this, my partners do the same thing now. A lot of the founders kind of say, we have to have them in. Doesn't matter if they leave, doesn't matter if they follow, doesn't matter if they, I just want them in because they challenge me and they give me what I need. So we like to think that in building a relationship, you just kind of got to build it as if you have an ongoing relationship rather than try to do a beauty parade, because the beauty parade ends up hurting you. And by the same token, if the investor starts off with you and the first thing that comes out of their mouth is, oh, this seems expensive, oh, those are kind of, this is how they're going to behave. This is how they're going to be in the negotiation. This is how they're going to be when they treat you on a daily basis. And so you don't want to be there. You want to have positive relationships. You don't want to have relationships with the person's already trying to figure out how they're going to bring down the price. The price will be what the price will be, and that will come down the line in a negotiation. But when an investor starts off the discussion by saying, well, I think you should do 2 million, not 4 million, and start in that approach without really understanding what they're getting into and the options, I think it kind of does the founder a disservice, and the founder should see it as a red flag.
Yeah, I think also what you mentioned about asking hard questions and also encouraging the founders to ask hard questions is kind of a way to look at your relationship moving forward. I mean, seeing how you work together, seeing how you discuss things, see how you disagree on things, and I assume that this should also give founders a pretty good idea of what it's going to be like working with you in the future.
Yeah, absolutely. And case in point, when I first started and I first came to Israel and I was doing my second or third deal, the founder had a great rapport with me, and then we got to talking about the numbers, and I said, well, why are you earning so much money? And kind of probably a mistake on my part, because the founder should have realized also at that point that I wasn't going to accept a founder earning double the market wage. The founder's mistake was to engage in a discussion like that the way they did by justifying why they should earn that amount when they were just starting out a business. And there are certain red flags that you'll pick up very quickly, and errors that you'll make as an investor as well. There are two sides to every story.
So we're getting, I'm getting a lot of questions in the chat about the early stage in raising money. So a lot of people are asking, when is it, how early is too early? Okay. When should we start looking for investment? Can we approach you with just an idea? What's your take on that?
Look, every investor has got their sweet spots. We will do things where there's an incredible team off an idea. We've got companies like Identic and Classic, where we actually worked with the founders to actually for almost 6 months to solidify the idea. And in one of the cases, even give them the name of the company. So, so we'll work very early with people, but different funds will get in at different stages. We're very happy to do what we call early stage and then early growth. So different funds, and early growth is kind of Series B-ish and beyond, and early stage will be kind of pre-seed, seed, that kind of effort. I think one as a founder needs to understand that if you come too early to a fund that doesn't do pre-seed, you're going to burn yourself, because they're going to think, what is this person coming to me for? They've done no work and they haven't built anything. So just understand when you go to a fund to understand where their sweet spot and which partner is dealing with the opportunity. And also, don't say stuff that you don't have. Everyone writes today that they've got AI and ML and VR and et cetera on the deck. And it's, everyone knows that it's 90% of the time bullshit, because you can't train an AI, ML, et cetera model in such short a time, and you don't have the data and et cetera. So it's just kind of, don't say that you have something that you don't have.
Yeah, it relates to an, sorry?
People aren't stupid, they figure it out very quickly.
Exactly. It relates to another question we received about how to build mutual trust with investors. And I think it begins with saying the truth as much as possible.
Saying the truth, and kind of be open to, not defensive, but be open to discussing what your thoughts are and how you get to the thoughts. People are interested in how you join the dots. So you can argue a point that we believe it's this size of the market and et cetera, and or you can say, look, if you take so many consumers and so many of them are female and so many of them are in this age and in this bracket and this kind of spending pattern, then it's normal to assume that this is the market size. So kind of walk through the logic and the steps, because I think that a lot of investors will appreciate far more what you've done if you walk them through the process of how you got to your reasoning, rather than argue your position.
So let's also talk about building that trust after the investment. So you mentioned it a bit before, but let's really talk about it even more in depth. Once you invest in a company, how do you expect the relationship to be with the founders in terms of how many times would you like to be updated? How much of the information are they expected to share with investors after the investment?
Yeah, I think so. So I think a mistake that founders make is that they start on a engagement process which is either too full of information or too frequent. The investor has invested for you in your business so you can run your business. The investor shouldn't be running your business for you. And it's a difficult dynamic to try and find a middle ground on. But it makes more sense to start off with a bit of information on a regular update of, say, once a month, and slowly build up more information if the investor asks for it, and if it makes sense to provide it, if it's a KPI or something that's measurable.
Right.
It doesn't make sense to provide data that is not a KPI. We've had like investors sometimes asking about how many AWS instances are you running. It's got nothing to do with anything. It's just kind of not part of the business. That they should be worried about. Also financials. It's important to, in the initial phases of the business, bottom line is less important. What is important is top line, revenue, gross margin, and cash flow. Those are kind of three key metrics that are important at the start of the business. Cash flow, how much money have we got left? All right. Revenue, how much money are we bringing in? That's an indication of how we are getting customers to adopt our solution. And gross margin is, do we have the ability to make money on what we're selling? And those things should actually show very concrete patterns and trends in direction. A lot of the other things don't really make sense. Some of the things you could say are customer acquisition cost, which is less important in the first year of the business because you're still learning and figuring out how to do it. Lifetime value, you can thumbsuck a number, but it's not real. You haven't had the customer for long enough to know what the customer lifetime value is. Maybe a bit in social gaming and things like that, but generally not. Average revenue per user is kind of, unless you towards the end of the first year, hard to understand. So you've got to be careful that you give enough information that the investor is sufficiently informed of what's happening at the business, but at the same time that the investor is not going to come back and hit you up with 20 more data points of information that they need.
Yeah, I think I can also share from my experience seeing how Monday does it, communicating with investors. So they send every quarter a deck for the investors, detailing the progress we made in regards to each KPI. But it's important to stress that everything we send out and we detail is related to a specific top line metric. I mean, we don't just share details that are irrelevant or are just nice to have.
Correct.
Right. So it's important to maintain that focus.
Yeah. So, and Monday is an example. The things that are important are things like MAP, which is kind of an indication of user engagement. It's ARR, in other words, how much new ARR have we added? Those are very important things, and those are frequent measurements. Monthly measurements are typically high-level information on revenue. Did we hit the targets? Did we spend enough money on marketing? The high-level information with some metrics. I think there's 10 KPIs we get. And the board actually only meets quarterly, officially. Unofficially, there's meetings and
right.
And we've got WhatsApp groups and things like that. But officially, the board meets now on a quarterly basis and runs through a 4-hour session of feedback to the board with a focus on 1 or 2 key things that we want to solve. And so I think that you should also, when you build your business, you should kind of consider that early on in the business, very few metrics. You don't want to inundate yourself with board meetings every month. You want to have a meeting every month with your lead investor, or a general call for 30 to 45 minutes, updating your investors, your angel investors, about the key things that you've achieved and your general asks, things that you want them to help you with, and leave it at that. Board meetings aren't an excuse to meet. Board meetings are to make statutory, regulatory, other kind of decisions that you have to officially take, and to ensure that you update on a regular basis the shareholder base of the company by updating the board. Again, don't become a slave to what the investor wants. Engage the investor positively, so you have a minimum set of metrics that keep them engaged and keep them interested, but at the same time, be very clear what you ask from them and when you ask it, so that they don't get thrown a whole bunch of things that, one is they can't solve, or 2, they have no interest in solving. It's not very often that your investor is going to find you employees. Recruiters find employees. An investor can help you find a co-founder. They can help you find a key hire. But to say to them you're looking for 5 full stack developers, they're going to give it back to their HR person who is getting the same request from 50 other companies in the portfolio. It's not going to yield a tremendous result.
Right. So the focus should be on more strategic goals rather than
strategic, actionable things. Yeah. I need an introduction to this person at Wix, and I can see that you 1 or 2 connections removed from them. things like that. And some VCs are very good at understanding marketing, or some could be good at understanding revenue models. So each VC or each investor may have certain reasons why you chose them, or why you wanted to use them, and have them invest in your business, and you want to leverage that. But just don't give them tasks that you're going to get disappointed with them for, because they're just not equipped to solve them for you.
Right, and I think this should also be a part of the due diligence a founder makes when choosing the VC, right? Not every VC is the right VC for the company.
Yeah, so it works both ways. When you are taking money from a VC and you know that a VC's got certain connections, or certain strengths, you want to play to those strengths, both in getting them on board, but also understanding from them right up front before invest that this is what you expect them to do. We've got the same thing when we invest now in a company. It took us years to come up with it, but as we sign the term sheet, and until we have the agreements finalized, we're doing some due diligence, but we're also building an onboarding program for the company, where we say, these are the weaknesses, these are the areas we need to focus on, these are the introductions we can make, et cetera, et cetera. So by the time we sign the document, the final document to invest, we have a 2 or 3 or 4 pager of key things that we need to do. And because we've researched them, chances are we're already kind of ready to execute on them. And hopefully we then share it with the founders, and the founders can pick up on it and implement what they want to out of it.
Yeah, I think it's also a great way to let the founders know how they can ask you for assistance.
Yeah.
How you can help them, because I think a lot of the times, and this is also questions we got, like, how do we ask investors for help? How do we help them help us?
Yeah, we get ready for it. Yeah,
exactly.
So it's actually an interesting thing I'm seeing here on the question. Someone asked, from your experience, when does a project become a startup? So again, I'm going to say to you something that was told to me 30 years ago. There's no such thing as small business. There's only small minds. Okay. And the context by which it was said to me was, you're either going to build this into a big business. If it can be built into a big business, you're either going to build it into a big business, or it's your mindset that's not allowing you to do it. No one else. And if you've got a small mindset, get out the way and let someone else run it, or don't do it. And the same thing I'll tell you with this. If you come to me and say to me, I've got a project, I'm not going to back you. Because a project is a project. A project is a beginning and an end, and you execute and you finished. A startup is passion. A startup is something that you are wholeheartedly involved with. It doesn't end. All right. It goes. You grow and you grow and you grow until the point where you're gone. Either you out of business, or you've sold the business, or you are Zuckerberg or Gates or Elon Musk, where it's too big to fail, kind of thing. But seriously, if you are looking at your next startup as a project, do yourself a favor and don't go there, because projects are finite, they're short term, they indicate, the word project kind of indicates to me that there's another project, that many projects are more going to be on the way. One's going to follow after this one. Either you're in or you're not.
So it relates to another question someone sent. How do you decide if the person you're investing in has got the right attributes to make a success?
So, when we look at investments, we've created a formula called the 4 T's, where we say it's timing, TAM for the size of the market, the team, and the technology. technology is typically easy to figure out. You can figure, I mean, it may be complex, but you can figure out what technology is. The targeted, the tangible market is something that you can generally come to some sort of general understanding on. Timing is absolute critical, because you miss something and you're going to be there for 5 years before it starts catching on, and that's going to take a heck of a lot of capital, and many times great ideas are just too early. And then the last one, which is kind of actually probably the most important, second most important, we in our formula, everything, it's timing multiplied by 10 plus technology.
בסדר? כי אני במקרה הזה לא שואל אותך איך הארגון צריך להיראות, אני יודע איך הארגון צריך להיראות, תכבד אותי.
Okay.
So the formula goes timing multiplied, open brackets, 10 plus technology, close brackets, to the power of the team. Okay, because it's ultimately the team that determines the success in technology and how you break into the TAM. And so the team is a paramount component. And so we're not just looking at an individual, we're looking at how individuals interact with each other, what sort of road they share. Why are Israeli investments, so many investments are, oh, they came out of 8200, they came out of 81, they came out of 99, you know, etc., etc. Many times these people have worked for 3 years or 5 years together in 8200. So yes, 8200, they're people who clean the floors, and they're also people who spy on countries and do, you know, a whole variety of things. They're people who translate. But the fact that they also worked as a team for a number of years is a fundamental advantage that you have over many startups overseas, where people have gotten together, they've done a bit of dating, and you know, they're off to the races. Great partnerships are typically based in people who have worked together before, or worked together for a long time, who have known each other for a long time. So for us, it's individual. We need people who are bright, who are open-minded, who are honest. Those are key characteristics for us. You can think outside the box. References play a big part. What their behavior is like historically, not necessarily if they were clever or not, but also how they reacted to things, and were they honest in their dealings before, and things like that. It's very important for us. And I think for each investor, they'll have a different set of requirements. But certainly the combination, the 1 + 1 makes 3 kind of thing is critical.
Okay, we'll move to another question we received about helping the company and the CEO specifically during a new fundraising round. So are there any actions investors can do, or specifically you as an early stage investor can do to help the company while they're raising their next round?
Yeah, so first off, early stage investors should have good relationships with follow-on investors. And when you look at their LinkedIn and when you're checking them out, see who their first connections are in LinkedIn. Make sure that they are related to not one, but a bunch of other investors. Have a look at the investments they made, and have a look at who followed those investments. So to get an idea of who trusts who follows who. And that's kind of first off when you get investors. Secondly, once you have an investor, the investor has to move to your side of the table. And what I mean by that is that they have to not leave you to try and fundraise yourself. When we go through a follow-on funding round, one is we try to show commitment early to our founders, to try to show them and to signal to the market that we're in and we're backing them. We believe they're going to be great. 2, plan it. There should be internal rehearsals. There should be a deck. There should be things like that. 3, we use Monday.com punt. But we use Monday.com for every one of our companies raising their next round. And we have a board dedicated to how we're doing the fundraise. And we have a board dedicated to what the funnel is of which funds we want to hit up and who we want to hit up at those funds. I don't like using a shotgun approach. I don't like spraying and praying, as I call it. My view is very much, I want to find 2 tier 1 funds, 2 middle of the road funds, okay, and 2 investors which are non-professional funds, and I'll go hit them first with the investment. I'll introduce the investment to them. We'll set up a call. We'll let them pitch to them, and we'll get some feedback from them. If the business is really, truly fantastic, the tier 1s are going to take it. If it's kind of okay, then the tier 1s may turn it down, but the medium-sized folks, the tier 2s, will take it. My backup plan in all of this is that if it's not a great business and I need to raise money from external sources, then I've got 2 people who are generally less strategic, less experienced, but I'm giving them an opportunity. And it's kind of, in my case, it's Entrée Capital. And my view is, I think that Entrée Capital is probably an above average fund. It probably has a good name, I hope, in the market. And so people will react to it and say, hey, you know, Avi's giving me a chance here. But what I do is then we'll go back and we'll analyze the responses. And from that, 1 is we haven't burnt our bridges. 2 is we can change the way the founders are discussing the business. 3, we can find out what's important. Is the consistency in what the important points are. We'd revise the deck, and then we'd do it again, but this time we'd do it with a wider audience, because obviously time is running out, and you want to make sure that the last 6 months of your cash flow, you're in that process and raising, and you don't want to leave it to the last minute. So our approach in helping our founders is very much connect them to the right people, back channel with those people to find out what they thought of it and what we need to do and what's missing, so we can go and whisper it in the founders' ears and get them to slightly change direction or effect a change in how they pitch, and learn from it. And so we think that way the chances of success increase for most businesses.
Yeah, it's amazing. It's kind of doing a small focus group for an investment round.
Correct.
Okay, another question we received is about negotiation. And do you have an example where a negotiation actually affected the relationship later with the founders? Or if you have a lot of term sheets, can it actually affect the relationship later on?
Look, I think that if you have the luxury of having a number of term sheets, then you make a pragmatic choice. Typically, you're not going to take the lowest, and contrary to popular belief, you're generally not going to take the highest. Case in point is when Monday did its funding round a year, almost 2 years ago, when it did the funding round, valuing it at just under $2 billion.
2 years ago.
There were underbidders, like tier 1 firms, that were bidding $1.4 billion for the business. There were 1 or 2 funds coming in over the top at $2.1 billion, I think, or $1.9 billion. And ultimately, we chose the term sheet that valued the business at 1.75 or something like that. And our argument was as follows. It's easy to not choose the bottom ones, because if they're so far off the mark, it's just not competitive. But generally, the ones that are the lowest are either fall into 2 categories. Either they like extremely fair, or they extremely unfair in their terms as well. There's no middle ground there. But what you find is that the ones that valued it almost near the top but not at the top actually gave it a lot of thought and actually showed a lot of consideration for the business and what could happen and why they were valuing it like that. The people at the top were label hunting, or they were trying to win the deal no matter what. And in most cases, those funds were either trying to prove something, or they were trying to, or they didn't really matter to them because the fund was so big. So when you've got a $5 or $10 billion fund and you're funding $100 million, actually in fund terms, even though to you and me it sounds $100 million a lot of money, to them it's chump change, because you consider a $5 billion fund, it's nothing. It's 2% of the fund. Whereas someone who's got $1 billion fund and is investing $100 million, that's 10% of their fund. So they've got to make it work. And so many times those discussions end up focusing you on who you want to take, not just the relationships with them. And I'll give you a case in point. Today, we closed the term sheet literally half an hour ago. And, that's why I wasn't on the test session before. But we closed a term sheet where we basically said to the investor, they were the lowest bid, but they were the most decent out of the 3 term sheets that we had. And the highest one was just they were just financial investors. The one in the middle was actually pretty good. We liked them. They were okay. They were a bit far away from the company, and they didn't have a substantial track record in these types of businesses, but they were fine. The lowest one was actually the firm that we liked the most in terms of the relationship. They have an office in Israel. They were close to the founders, etc., etc. But they were completely off the mark. And my view to them was very simple. Is we said to them, look, either you sign the term sheet at this valuation, and the valuation was about 10% too low from the one that we liked. So we said, either you sign it, same terms, we accept all your terms, but either you sign it at this kind of valuation, which makes sense, which is fair, which is the middle of the road. It's not the highest, it's not the lowest, it's kind of in the middle. Either you sign it, or I'll give a term sheet to the business and at that value, and I'll sign it because we know worse off. And we actually took the term sheet, we changed the number, we signed it, and we sent it to them.
Wow.
And I think they realized that it wasn't us being arrogant or anything. It was just us being fair and realistic. At the one valuation, the historic investors wouldn't get enough of an uplift. At the highest valuation, we'd be it wouldn't be fair. But in the middle of the valuation, the middle solution was actually a fair solution. And if they really believe that this business is going to be $1 billion outcome, paying an extra $5 million is just a nothing. For this kind of level of investment, where the pre-money is just under 100, it's just kind of 5 million on a valuation is 5%, 7, 8% on valuation just is not material, when on the other hand, you telling the founders how you're going to help them make it $1 billion business. So I think you just need to have good investors who have your back. And if you have good investors who have your back, it kind of helps determine which term sheet you should take. Having said that, I can tell you that at least half the businesses aren't in that luxury. Half the businesses have got one term sheet and they can either choose it or not choose it. Yeah. And unfortunately, their existing investors are too afraid to negotiate a position which is not right, but just a position which is not fair. So all you want is a fair deal. Don't be too greedy, but also just believe in yourself and believe. If you believe you can do it, then explain why something fair works for everyone. And that's an important lesson. I think it's kind of been in the last hour. We've said it a couple of times.
Yeah, definitely. I think what I learned from you is the fact that founders can actually use their early investors later on, also on growth rounds or second rounds, whatever, even if the investor won't invest in the second round, you can really help them get better terms, get get an investment from the right VC, choose the right deal for them.
Sure.
And another question.
In closing, there's, I know we're almost out of time. There was a question here from Yariv saying, should investors or VCs be involved in maintaining founders' mental resilience or efficiency as the startup evolves? I don't know many VCs who are psychologists. So they're not your psychologists. And a challenge on the one hand, I think it's right to share with an investor that's very close to you. It's okay to share personal things, but I think you always need to maintain some basis of professionalism, because that investor invested in you to get a return. Ultimately, they didn't invest in you to become your mate. They're in it for a return. So even though you end up being friends, and even though you can share information, and we've had times where I've had founders knocking at my door, coming inside and having a cup of tea or a bottle of whiskey, and kind of like really mentally drained or that situation. And it's important to know that you're there for them, but you're not their father, you're not their mother, and they need to maintain it. An interesting example is my first investor in my first business. I had a situation where I'd started my first business to fund my way through university, and because I didn't come from money and I needed to pay for university, and there I was building this business, and I just finished my degree. Took me an extra year and a half to finish it. I did engineering, but I had like 40 or 50 employees, and this business had grown. And I was approached by Microsoft. I flew to Redmond, and they offered me an unbelievable job. I'd probably be kind of in the CEO's office right now, not the CEO, kind of, I'd be very high up in Microsoft. I took it. And, they couriered me. There were even FedEx in those days. They couriered me like all the swag from Microsoft and the new keyboard. No idea how they were lavishing me on the stuff, because they wanted me to join. And I'd said to them, but I've got a business. And they thought I was joking or something, or it was like a mom and pop stand kind of thing. But I got back, and I'll never forget this. My investor, the person who backed me, he asked me to drive him to the airport, and I'm driving him to the airport, and I say to him, this is my problem. I'm just don't know what to do. I've got this most unbelievable position at Microsoft. This is like in 1994. They're going to pay me $6,000, more money than I've ever seen. I don't think I'd earned $6,000 in a year in my business at that stage. And I'm going to get options and free swag and free milk in the fridge and everything else. And I can go to America, Who doesn't want to go to America? And on the other hand, I've got this business here in South Africa, and I'm grinding my teeth trying to get people to understand what I'm trying to build, and I can do it. And he turns around and he looks at me, and he says to me, and he said to me, Avi, like he used to speak in a certain gravitas. He said to me, Avi, it's only your psychology. And that was it. And and then I dropped him off at the airport. Not a word was said. But it kind of got me thinking. And I then went on to build this business into a company that merged into a big public company. It was a big success. And it told me a valuable lesson that one is, you're not alone. Don't think that you're alone. But be able to put yourself aside and understand the situation you're in, whether you consult with someone else or not. I mean, I had like one word answer to this massive problem I'm having with the rest of my life. But the seed was sown. And so the same thing I can tell you, that your psychology is very important, but your psychology determines the outcome of the business. And so you need to be able to consult with the right person, or have the maturity to step out of the box. See the wood from the trees, and et cetera, but you need to be able to do that. And so many founders get trapped in working 18-hour days and et cetera, and grinding away and expecting a certain result, but not really figuring out that they're looking at the problem incorrectly, or they're not dealing with the situation, or that they could be the challenge themselves in the problem. And so, I think that it's an important lesson.
Yeah, I think it's a great story to end with. And I see people here summarizing your quotes and writing it on the chat. So
copyright trademark.
yeah, I think we can print everything out later and frame it and send it to everyone as swag, not like swag for Microsoft, but
yeah, that's a good one. It's only your psychology.
Yeah, we'll make stickers.
I'm gonna put on the shirt.
Yeah. And I think we'll end with that. So thank you very much, Avi.
Thank you. I hope it's helped at least one or two people along the way.
For sure. I think we can continue for another good hour, but we'll leave it at that. And thank you so much, and I'll let you in on the stickers when it comes out.
Please do. Thank you, everyone, and good luck with your businesses. And by all means, please send us your plans, ideas, business decks, etc. If you want us to just kind of breeze through them, or if you're actually raising around.
Thanks, everyone.
Okay, thank you.
Bye-bye.
Have a good day. Bye-bye.
Thank you.